Well, hi. Welcome to our today's webinar. I'm Mike Swanson speaking to you from Nashville, Tennessee at the headquarters of Advocate Capital. This webinar is brought to you by Advocate Capital, and we are the providers of the AdvoTrack case expense funding service for law firms around the country. But we're not going to talk about that today. Today we're going to talk about the topic of proper accounting for case expenses for tax purposes. I'm very pleased to have joining me today a special guest, and his name is Tim McKey. And we'll talk about Tim in just a moment. But Tim is hopefully going to log in here. And Tim, we're ready to see you on cam when you're ready. This is me. I am the CEO of Advocate. I'm also the author of a book called How David Beats Goliath. And this is the only finance book ever published to help plaintiff lawyers understand the finance world. Today's special guest is Tim McKey. And Tim has very important background. Tim is the co-founder of Vista Consulting, and he is also a CPA. So I've asked him to join us today since we're going to be talking about some accounting issues. Tim and I both run organizations that are unusual in that we are actually Seventh Amendment advocates. We believe in what plaintiff lawyers do, and we have organized our teams around that to help them understand and do better. So without further ado, here's Tim. Hi, Tim.
Hi, Mike. How are you?
Fantastic. How are things in your neck of the woods today?
Things are great. Beautiful weather, warm, but all good.
Yeah, it seems like here in Nashville, we finally escaped winter. We actually had a winter this year, which is fairly unusual. So great. Well, thanks so much for joining us today. And Tim and I wanted to provide some information for you today, but first a disclaimer. So this webinar is for informational purposes only. So although Tim is a CPA, I am not, and neither of us are lawyers. So we're not here to provide tax or legal or accounting advice for you today. Our advice to you today is to listen and watch what you see, and then consider that information and consider sharing it with your tax, accounting, and legal professionals to see if you want to make some kind of change at your law firm. So this is for informational purposes only. So we're going to be talking about where cases expenses should show up in a contingent fee law firm's financial statements. But before we get to that, I want to do a very quick review of two financial statements. I don't want to assume that our viewers review financial statements all that often. So we're going to just take about 1 minute to talk about two of those. So the first one we're going to talk about is an income statement, and then we're going to talk about a balance sheet. What is a balance sheet? We'll start with the income statement. So an income statement is also known as a profit and loss statement, okay? And an income statement also covers a period of time. So it has a starting point and an ending point. So an income statement could be, let's say, from January 1st to January 31st, or January 1st to December 31st if it's an annual income statement. So it's important to keep that in mind. It covers a period of time. Most simply, an income statement is what you receive minus what you paid out, and then you have what's left. So, but on the income statement, we see that described as income minus expenses equal profit, or it could be a loss if your expenses exceed your income. Here's an example of a typical law firm profit and loss or income statement. You'll see it has three sections: income, expenses, and profit. All right, let's talk about a balance sheet next. A balance sheet is different from an income statement in that it is a snapshot in time at a particular point in time. It's not a range of dates, it's a snapshot in time. So it could be a snapshot at any given date. And it also is what I like to think of as a kind of a net worth statement. Not exactly, but pretty close. So a balance sheet you can think of as what is owned minus what is owed is what's left, which is net worth. Now on a balance sheet, we don't call it that. We call it assets minus liabilities equal equity. It's a little more detailed. If you want more detail on these financial statements, I have another webinar called Law Firm Finance 101. That's available on the Advocate Capital website. Click on videos, scroll to the bottom for webinars. So you see a typical balance sheet looks like this: assets, liabilities, and equity. So just wanted to review, just in case a few of you are not that familiar with financial statements. So let's get to our topic now. And I want to start having Tim chime in a bit. So our big question is, Tim, where should case expenses appear on a law firm's financial statements?
Yeah, I'll jump in and say, first of all, let's explain or define what we mean by case expenses, and then we'll talk about where they go. Case expenses, in what we're talking about today, are the cost that you are investing, if you will, in your cases. Things such as court costs, maybe the acquisition of medical records, possibly expenses for experts, and those type of things. The expenditures that you're putting into the case for today's purposes are what we're going to call case expenses. And, the question, where should they appear on your financial statements? And Michael just went over, what a profit and loss is, or an income statement and a balance sheet. Intuitively, you would think that case expenses would go on the profit and loss statement, because that is an expense of a case. The IRS, however, has a very different perspective on that. They see those expenditures, and I'm going to try to differentiate a little bit between deductible expenses and expenditures, which is just money going out. Those expenditures that are investment in your cases, the IRS's position is that you are actually loaning money to your client. So therefore, it is an asset to you, or a receivable, which, again, going back to the little example that Mike made, would go on your balance sheet as an asset. It is what, I like to term as, you've got the good stuff, which is the assets, the bad stuff, which is what you owe, and then the bottom line, which is equity or net worth. Lots of different ways to look at it. But where should they go? Really, the IRS's position is that they go on the balance sheet as a receivable from your client.
Right, and so as you and I both know, that has been kind of codified, if you will, in this IRS private letter ruling 8246013, the first page of which is on the screen today, and this is where it was first kind of published way back in 1982. And by the way, if you'd like copies of any of the documents that we're going to show you today, this is not for you to read on screen, just to kind of show you that it exists. Just send me an email after the webinar, and I'm happy to get you copies of these. So, Tim, can you tell us about the PLR and what PLRs are used for?
Sure. A private letter ruling issued by the IRS only has authority, if you will, for that one particular case. In other words, in the vernacular of tax law, if you will, it is a private letter ruling is not a concrete precedent that can be used over other cases, if you will. However, private letter rulings are often brought up in other cases, but the authority that it has is really on a particular case. And if you actually look at a copy of the private letter ruling, you'll notice that individuals' names are redacted, company names are redacted, because, again, it's only particular to that particular case. And in this case, a company requested a letter ruling from the IRS specifically on how to handle advanced case costs, the costs that we just described a little bit earlier. And they came down very unequivocally on the fact that they are loans to your client and therefore not a currently deductible item that would go on your profit and loss statement. So this is kind of the first indication, or at least the first one from my knowledge, that attempted to codify a little bit, even though, once again, it's only particular to this case.
Right. Now, you shared with me earlier in the week, or maybe it was last week, that this kind of information has also made its way into the IRS Attorney Audit document. Can you talk about that?
Yeah, I can. The IRS publishes from time to time for its agents audit guides. In other words, if they're looking at a particular industry, they have listed out certain areas of a particular company in that industry that the auditors should pay particular attention to. And I think you want to go to the next slide, maybe, Michael. I think that's the, if I remember correctly. Nope, not, or maybe I'm wrong. There it is.
This is page 35.
Yeah, this is, again, just a snapshot of a page of the Attorney Audit Technique Guide. But what is in this particular guide for plaintiff attorneys is they are asking their agents to pay particular attention to how the attorney is accounting for the advanced case cost. And it goes into a good bit of detail of how they should discover where these costs are being carried, and if they're, I'll say, in the wrong place, how the correction should go about and what the audit adjustment could possibly be.
Right. So this is the actual guidelines for auditors in the field for the IRS, right?
Right. And it's, and again, auditors all have lots of flexibility into what they look at. And just as a little bit of an aside, most of you have probably heard that the IRS is right now fairly understaffed, if you will, and there's obviously lots of changes. What we're seeing, at least in what I'll say in my CPA practice, which is a smaller part of what I do, but we're noticing that IRS audits are much more targeted than they've been before. In other words, the early part of my career in the mid to late 80s and 90s, if you were audited by the IRS, once they got their nose under your tent, if you will, they really looked at almost everything in the business. What is happening now is you'll get generally, and again, it's not always true, but generally the IRS will say, hey, we want to come in and look at something that looks unusual in the income part of your tax return, or a specific expense item, or attorney case cost. So they're being a little bit more targeted on how they look at these things. But again, the IRS agent has flexibility.
Very, very good. So let's change gears now. So these are two documents that would seem to indicate that case expenses should be booked on the balance sheet, right? Because it categorizes them as an asset, not an expense deductible against current year income. Let's talk about the Makar v. Commissioner case a little bit. Can you tell us about that case?
I can. And Makar was a case that began back in, I believe it was the mid 80s, where Makar was a company, a law firm that was currently expensing their case cost. And they were audited, and an adjustment was proposed to move those expenses from the profit and loss expense side, if you will, to the balance sheet. And the service assessed additional taxes because of that, because it took away a deduction. Makar then went to the tax court, and the tax court upheld that finding by the auditor. But in 1995, the Ninth Circuit took up the case again. And I'll say this way, they basically upheld the original decisions, but with some very minor caveats in there. And I'll try to explain that. What the Ninth Circuit said was, if the law firm had a very specific type of contractual agreement with their client that is referred to as a gross fee contract, and I'll explain that a little bit. You can go ahead and put the rest up, Mike. A gross fee contract versus a net fee contract. If it's a gross fee contract where the attorney is saying, look, we're going to work this case for you, we're going to pay the expenses, and then we're going to share an agreed upon percentage of whatever the gross amount is that is the recovery. Well, in the Ninth Circuit and in the Makar reversal, they said, the court said, the Ninth Circuit said, that if you have a gross fee contract, then you can actually deduct the fees, the advanced case costs. Okay. That's what the Ninth Circuit said. And again, just to kind of give you a contrast between gross and net fee contract, gross fee, as I explained, you only receive a percentage of the gross without respect to whatever was put into the case.
Got it.
What we see in practice mostly is a net fee contract, where if the attorney has advanced case costs, those costs are agreed to be recovered by the attorney, and then a percentage of what's left is shared. Makar, or the Ninth Circuit Court of Appeals in Makar, said if your gross fee, yes, we see that as an ordinary and necessary expense that can be deducted on the income statement. But if it's a net fee, it's just like we said before, that's still an asset, a loan, and you cannot actually recover those costs or deduct those costs until such time that the case is resolved.
Okay, that makes sense.
That's the big deal in Makar. One other thing, Mike, is that the IRS still doesn't really recognize Picardo. So,
okay, tell me about that. So in other words, it didn't make it into that last document we saw, right? Picardo's
it did not make it into the last document. You know, in the audit technique guide, which the latest one that I believe is out there is 2011. Right. Picardo, the Ninth Circuit reversal happened in 1995, but the IRS still says no matter what, we're going to continue to look at this as being correctly carried on the balance sheet and not a current deduction.
Great. I'm going to stop screen sharing just for a moment, just to make the video a little bit more prominent. So Tim, in this matter, then I guess a law firm who's in the Ninth Circuit that has a gross fee contract might have enough confidence to go ahead and continue to expense case expenses. But talk a little bit about why a law firm might not want to lean on the Picardo decision.
Right, and I think you are right. The guys that are outside of the Ninth Circuit that are currently deducting the advanced case cost don't have as good an argument, if you will, as the people in the Ninth Circuit. Sure. But why do I think that proper accounting is on the balance sheet? Well, there's several reasons. And again, I don't work for the IRS. I want to make that gotcha. Perfectly clear. But if you really think about what's going on, the attorney in most cases is making a loan to their client, then that loan will only be repaid on a recouping, if you will, of case cost. Right. So therefore, carrying those on the balance sheet makes sense. It's a receivable from the client. Mm-hmm. The other thing, the reason that I like to see them carried, those case costs carried on the balance sheet, is for really clarity of profitability in a law firm, and I'll explain that. For example, if you're in a firm that's growing and you are carrying the case costs on your profit and loss statement, in other words, you're expensing those costs as you incur them, but your firm is actually growing, then you are investing money in cases that show up as an expense on your financial statement, yet they're truly an investment. Mm-hmm. It can very much distort, if you will, the profitability of your firm. Carrying it on the balance sheet says that, hey, I have this investment out there, and when that case resolved, we will pick those costs back up, and they won't be taxable, or heaven forbid, if we lose the case, we will write them off at that point in time. But it causes a very much of a distortion, if you will, from a management standpoint.
It makes a growing law firm actually appear less profitable than it really is.
That's correct.
And it makes it appear to have less net worth than it really does, because it's understating the asset.
Absolutely.
Got it.
Absolutely.
Okay, so I can see what you mean by a distortion of financial statements. And if you're presenting those financial statements to, let's say, a potential lender, the lender might not be sophisticated enough to know that that's happening. You're presenting financials that might not be totally accurate. Not that there's anything wrong, but you might not get the result you want, for example, on a loan application, because you might look less profitable and have less net worth than you really do. Tim, another thing that we've noticed, and we've been reviewing the financial statements of contingent fee law firms every day since 1999. It's one of the things we do all day, our team, not just me. But what we've noticed is that if you don't have your case expenses on your balance sheet, you don't even know how much you've loaned to your clients. And I can't tell you how many law firms I talk to, and I'll say, how much do you have out in your case expenses? And they just don't know. They'll say, well, I think I spend about, $300,000 a year, but they don't even know the value of that asset. So again, just in terms of clarity as to what's really happening at the law firm, they've built an asset they don't even know how much it is. And they've loaned their cash to their practice, and they don't even know how much of their cash they've loaned. All they know is how much you're loaning on an ongoing basis. So that's one other thing. But, Tim, also, what happens if a firm gets audited?
Well, if a firm gets audited and they're carrying it on their balance sheet, everybody does a little dance and they're happy. But if they're not, and they're actually deducting those costs on your profit and loss statement, the IRS certainly has the right to say, hey, all of those expenses that you've put into advanced case costs for the last 3 years, because that's a statute of limitations, they can yank those out and take away that deduction. And then obviously that generates taxes and potentially penalties and interest.
So if you've deducted, say, $900,000 of case expenses over the past 3 years, you might get a tax bill for what, a third of that?
A third of that, roughly. Yeah, there's, yeah, it's not a fun day.
No, and we know through experience, because sometimes we have law firms who have problems who contact us, we can't really help them, but they have tax liens. And we've seen that, where if a law firm can't pay that tax bill right away, well, they'll slap a federal tax lien on your law firm, and that really causes a lot of problems. It affects your credit score potentially, affects if you have an existing lender and they come to renewal time and see a federal tax lien in place, or even a prospective lender. So those federal tax liens can be a big barrier to your ongoing business as well. So interesting. One other thing that I've noticed that might cause someone to try to pull the trigger here soon and make the switch from expensing to booking it as an asset is that this is really on the radar of the Republican led Congress and Senate. And I don't know if our viewers know this or not, but in both versions of the tax reform bill that came to be reconciled before Congress this December, both versions essentially had PLR 8246013 written into law. So it almost became tax law that you cannot expense your expenses; they have to be an asset. And boy, if somehow amazingly AAJ, to their credit, got that stricken from both versions of the bills, when they got reconciled, it was completely gone, which doesn't normally happen, right? I mean, normally when Congress reconciles two bills between Senate and Congress, they're looking for differences, right, to reconcile, but somehow it got stricken, which is kind of a bullet that our industry dodged. So how much longer?
It's a bullet that the industry dodged, but actually, we believe that carrying them on the balance sheet is the correct way to do it. We're kind of holding out hope that at some point something like that could change. And it could become, and then we would make some adjustments from a management standpoint of how the books and records were kept, because we're very big on having the financial statements set where you can get relevant management information. And lots of times books and records are kept internally for tax purposes. So sometimes there's some adjustments that need to be made to make sure that, hey, we're understanding this properly. So it's very important that books and records are kept, if you will, on a management standpoint. And if you need to make adjustments for taxes, go that direction as opposed to the other way around.
Yeah, good point. Okay, so let's talk about a firm that maybe watches this content, takes it to their professionals. The professionals say, yeah, you might want to change. What does that look like? How might that happen? What are the pain points if they do that? Do they need to consider?
Well, there's a school of thought that says that this is a whole, and this is a term of art, a change of accounting procedure, and that has to be disclosed to the IRS that, hey, we're changing something major. I don't tend to buy into that too much. I think that this is certainly a change in, I'm sorry, I said accounting procedure, and change in accounting method. I think this is a change in accounting procedure, which is, in my opinion, can be done without disclosing to the IRS. What I like to see happen, and we've helped some firms do this, is basically you draw a line in the sand and say, hey, at February 28th, we're going to begin handling every new case cost as a balance sheet item. Okay. And basically what you do is you wind up on your balance sheet and you wind down on your income statement. So depending on the life of your cases, over 12 months, 24 months, et cetera, you have your books and records adjusted. But I have to warn you, and Mike, you know this, that can cause some tax liability over time, as you are now expending money that you're not getting a current deduction for.
That you were in the past.
Yeah, so you need to be very careful with that.
So there could be a cash flow pinch right there, right? Because now suddenly you have less and less to deduct each month in terms of expenses since you're switching over to doing it right. Okay, that makes sense. And so you experience more of that phantom profit situation, right?
Exactly. That can be a real issue.
And then once you do it right, the reality is the only cash in a law firm that's available for use as case expenses if they're booking it properly would be after-tax cash, right? So now they're going from loaning their pre-tax cash to their post-tax cash to their practice. So there are some pain points.
Absolutely, and that can cause some cash flow and some tax problems.
Right. So what steps might a firm take to kind of lessen the pain if they're going to make that change? What are some things they might be able to do to lessen the pain of that?
Yeah, this is a shameless plug. You can go to somebody like Advocate Capital and you can borrow the money that you advance, if you will, to your client. So it's kind of a pass through, if you will, where you can borrow that money, pass through, and as I call it, kind of no skin off your nose law firm owner. The money is collected at resolution, goes back to the finance company, and therefore you do not have, you're not creating for yourself a cash flow or a tax issue because it's simply a pass through.
Right. Well, thanks for the plug.
Thing that, go ahead, I'm sorry.
No, we appreciate the plug. You know, our product, the AvaTrack Case Expense Funding Service, is technically tax neutral. It's just a loan with interest pass-through. But we have seen firms use that at a point in time when they need that additional cash flow. Okay, now might be the time to switch to Advocate because now I can get that after-tax cash out of my cases and help with that little bit pinch in cash flow from the change in the accounting method that you mentioned. So that definitely does happen.
Right. I'll make a distinction here, too, between what I call good debt and bad debt. And, you know, I am not an advocate of debt pretty much in any way, shape, or form if you can avoid it.
Right.
But,
a lot of firms tell us we're debt adverse, and we're, you know, genuinely, that's a great thing. I mean,
no, and I agree with that. But again, this distinction that I want to draw between the two types of debt is the borrowing to invest in your cases. And I'll just put the term good on that for a second and put it on the shelf. Borrowing to run your operation, not good. Because if you're borrowing to make payroll, if you're borrowing for other things, then that means your firm is truly not profitable. And quite honestly, that's unsustainable over a long period of time. But to go back and take off the shelf, if you will, what I'll call good debt for a second, that debt is on a constant roll, if you will, because you're borrowing from a financial institution, loaning to the client, and as that money, as the case resolves, and I'll say favorably for the time being, the money comes back in, you take care of the financial institution, and you move along. The other thing that I'll point out is, well, that's the first thing that happens when the case resolved is the financial institution gets paid. If the case resolves negatively, you have money invested in the case, I still say the first thing you do is go then to your operating account, pay the financial institution off, and then that amount is actually a tax deduction. That is a bad debt, and you can write that part off. But again,
along with the interest,
we don't talk too much about that because that means you haven't done well on the case.
Yeah. Yeah, but it is deductible. It takes a little of the sting out of it when you do lose the bad case. But you know, our experience is that most contingent fee law firms get their expenses back on their cases about 95 to 97% of the time. So they have the law of big numbers working with them if they are going to finance basically their entire inventory, not try to pick winners and losers too much. So of course we would say check with your ethics counsel in your state. 31 states have opined on interest pass-through. We can get you a copy of an opinion in your state if it exists. We also would say be sure to disclose the concept of interest pass-through to your clients in advance in the fee agreement, and we can help you with fee agreement language if you'd like that. So good. Well, I know that you've helped people for a long time, Tim, in our industry. We have many clients who use Vista and say good things about you, and we appreciate you being on here today. Let me just reshare my screen here so you can see that. Hopefully that will appear shortly. So I think we've covered most of that. Tim, did I miss anything?
I don't think so. I just, we touched a little bit on or maybe we didn't touch on the possibility of passing the interest charge along. You hit that, I think, really quickly there at the end. But that's as Mike said, I think in 31 states, you said,
that's right.
That's been ethically approved. We certainly advise to get to make sure that is ethically appropriate in your state and to disclose. We have seen some contracts that don't have it specific. We prefer to have it very specific in the contract.
Yeah, we recommend that too. We've been doing this for 20 years or so, and about 465 law firms around the country. And we know that if a firm discloses it upfront in a detailed way, they're not going to have any trouble with that. So, hey, the disclaimer's back on the screen, Tim, and we want to remind our viewers that this is not meant to be accounting or tax or legal advice, but you may want to take some of the information you saw today and share it with your professionals, have a conference with them, and see if you might want to start doing things a little bit differently. Right now, I'm going to open it up and see if we have any questions. Let's just give folks
and if any of your professionals would like to talk to me, I would welcome the call.
Great. Well, let's give them that information. Here's how to contact Tim McKee. Tim's website is VISTACT for Vista Consulting Team, I guess. I hope I got that right. Yes,
right.
.com. And you can reach Tim. His number's on the screen. We'll also put this information in the text below the video because we're going to publish this on Vimeo and on YouTube. Those of you who weren't able to attend, they'll be receiving everybody who registered will receive an email and a link to that. So we welcome your questions there. I don't see any online yet. If you would like to contact me, feel free to do so. mswanson@advocatecapital.com. You can call our main number, 877-894-9724. If you'd like, again, copies of any of the documents we talked about today, shoot me an email. We'll be sure to get that over to you. More information about our company at advocatecapital.com. And we have more and more webinars posted on our YouTube channel. You can either go to our website, click on our YouTube link there, our video link there, or go directly to YouTube to our YouTube user channel. So great. Well, Tim, I want to thank you very much again for being with us today. Great information.
You're very welcome. Thank you so much for having me.
Terrific. I don't see any questions, so I think we're going to sign off to all of our attendees today. Thanks for attending, and stay tuned for our next great webinar. Next month, we'll be looking at how to choose the proper retirement program for your law firm. So stay tuned. Thank you all.
Thanks, Mike.